Hey guys, Daniel Clayman here, and I've been long meaning to record the second content video for you on private money structuring. This is a follow-up and sort of builds and expands on the first private money structuring video, and this one is going to be called 6 Ways to Structure Private Money Deals. And the goals are to learn how to structure private money deals with the most flexibility. Some of you who are watching are already doing private money deals. Some of you are just learning how to, but I want to show you how to structure deals in the most flexible manner, because that will allow you to create a lending scenario that is tailored to your potential lender's risk and return appetite. You'll find that certain people that you deal with have a higher risk appetite and tolerance than others and will require a higher return than others. And lastly, I'm going to show you how to present your lending proposals in a very intelligent and organized manner, which will allow you to look like a pro and obviously get funded. So I'm going to use the Rehab Valuator software to show you how to structure these deals and present them. A lot of you who are watching are already Rehab Valuator premium clients and are able to do everything that I'm about to show you. But even if you have only the free version, you can use that software to structure your deals. You just can't generate the presentations for your lenders. So if you don't even have the free version of our software yet, go to www.rehabvaluator.com and download your copy so you can follow along with what I'm doing, and so that you can start structuring deals in the same manner. And take notes and pay attention. It's only worth your time to watch this video if you actually pay attention. If you take the time to learn what I'm about to teach you, you'll be able to speak to potential lenders as if you were a seasoned investor, even if you've never done a deal. And this is not a short video, but it will be full of quote-unquote meat and potatoes. If you've been following me and watching my videos, you know I hate fluff. There's not going to be any inspirational quotes or motivational speeches in this one, and you get enough of that from the gurus. So I'll also show you some ways to structure deals quite differently from how most other investors do it. And again, this goes back to flexibility. By the way, if you haven't watched the first private money structuring video yet, I would probably watch that first. You can find it under case studies on the Rehab Valuator site. You actually should have a menu above this video if you're on my site. Just look under case studies and then look under private money structuring. And it's about solid 45 minutes of content there. So let's go over some basics first before we get into the nuts and bolts. What is private lending and why is it important to you in your real estate business? And again, if you've watched the first video, this will be kind of a rehab, not a rehab, a recap. Again, I'm a foreigner. My English not so good. This will be a recap of the introduction in that video, right? So there's primarily there's three major types of financing for residential investment real estate. And again, for the purpose of this case study, because I can't cover every niche, every exit strategy, I'm going to assume that you're buying residential real estate, you're rehabbing and flipping it. But the same principles can be applied to other deals. Just for the purposes of this case study, of this video, I'm going to assume that you are doing residential deals. So for residential investment real estate, there are really three types of financing. There's bank financing, there's hard money lenders, and there's private money lenders. Are there other sources of capital? Sure, but these are the three primary ones. Bank financing really contains two different groups. One is the conventional lenders, Fannie, Mae, Freddie Mac. You've got all sorts of issues with getting financing, especially if you're an investor, from the conventional lenders. There's a limit of 10 mortgage properties that you can have. They go back and forth between limits of 4 and 10. I have no idea what it is now because I don't deal with these lenders. They have very strict financing guidelines. They require a ton of paperwork, very good credit, 20-30% down. You need a note from your doctor. They give you a personality test. You get the idea. It's very hard to qualify these days, especially for investors. And if you've tried, then you know what kind of a nightmare it is. Then you've got the portfolio lenders. These are your local community banks and credit unions. The difference between portfolio lenders and conventional lenders is that portfolio lenders are easier to deal with. They're called portfolio lenders because the loans that they give out are mostly kept in their own portfolio. They don't sell these loans into the secondary market, and so these loans don't have to meet the Fannie and Freddie strict guidelines. So because of that, you've got less restrictions. Again, because these loans are generally kept in-house. So if the bank lends their own funds to you, they can create whatever lending guidelines they choose. And that allows them more flexibility. But you still must qualify based on income, credit, global cash flow, and balance sheet. These are mostly considered commercial lenders, which means they're a little bit smarter about evaluating you and understanding your business, and so they can be flexible, but they still need you to have solid income, solid credit, and they look at everything that you have, your assets, your other properties, your balance sheet. And again, because these are mostly commercial lenders, that means that the loans carry short-term calls. So if you buy a property through a portfolio lender, they will typically call that loan, or it will be an ARM in 3, 5, or 10 years. And I deal a lot with portfolio lenders. I actually like them, but I have a very large portfolio at this point of loans that is going to reset or get called starting 2014. Between 2014 and 2016, I think I have about $3+ million in loans that is going to reset, which brings me a lot of interest rate risk. Then, of course, if you can't qualify with either portfolio lenders or conventional lenders, based on income, based on credit, you can go to a hard money lender. If you're rehabbing and flipping, you can find a hard money lender in your area, but they're very expensive. They only lend short term, typically under 12 months, and they charge a lot for the money. Hard money lenders make profits by turning their money over quickly. So that's why they won't lend to you for over 12 months, because they mostly make their money on points. You pay them 4 to 8 points up front. Points is just percent. And they typically charge you a 12 to 16% interest rate. So if you're borrowing $100,000 from a hard money lender, typically this will cost you $4,000 to $8,000 up front, or sometimes they tack it on the back end of the loan, and another 12 to 16% annual interest rate. It's very expensive money, and you need to have an assured exit strategy and really a very solid deal before taking on hard money. Assured exit strategy is required because if you can't get out of that loan in 12 months, then they can either take the property from you, or the interest rate. I've seen a lot of hard money lenders where the clause essentially stipulates that if you don't get out of that loan in 9 or 12 months or whatever it says, the interest rate jumps and becomes quite a bit higher than it already was, which is 12 to 16%. So it's very punitive if you can't get out of that property in the time allotted by the hard money lender. And you need to have a very solid deal, because if you're paying 15 to 20% annualized on your money, that's really going to eat into your profit margins. So your deal has to be incredibly strong for you to still make money after paying all this interest. And then, of course, you've got private money, which is borrowing from individuals. There are very few regulations. The more regulations really exist for how you solicit private money than for how you structure your private money deals. Documentation requirements are really up to the individual, to the lender, usually very little. Terms are as flexible as you can imagine, right? Anything you can structure that your private lender agrees with you on, those are the terms. Typically, there are no loan-to-value limits, etc., etc., etc. So private money is traditionally the most flexible money that you can find. So for example, if you want to buy, rehab, and flip a house, you can go to either a local community bank or credit union. Oh, and here's the other thing, right? So for the purpose of this video, we're assuming you're buying and renovating and flipping a property. Well, conventional lenders for investment properties, they will never finance your renovation. There is what's called a 203K loan, but that's only for owner occupants. So if you want to get your acquisition and rehab finance, you can go to a local community bank or credit union and you can get a construction loan. I actually get these from time to time on bigger projects. You will again need to qualify based on income, credit, assets. It'll cost you 1 to 2 points, 5 to 8% interest rate, and typically a 6 to 12 month term, after which loan will get called or roll over into what's called a mini perm. So I like construction loans on bigger projects because it's not expensive money, but you still have to be able to qualify, and the qualification process can be pretty intense even with portfolio lenders. You can go to a hard money lender and get your face ripped off. If the deal is strong, you don't need to have good credit, income, or assets. Hard money lenders look purely at the deal. But again, it's very expensive money and you must be able to rehab and sell the house under the terms specified or lose the house to the lender or pay even higher interest. Or you can get a private money loan. And again, a private money loan is simply a loan made by one individual to another, usually backed by real estate. Terms between you and your private lender are completely up to you. So in a typical private money transaction, you, the borrower, receive a loan for X amount of money from private lender in exchange for a monthly interest payment based on X%. Usually you give them a deed of trust or a mortgage on the property, depending on your state. And usually there's also a promissory note for the amount of the loan, promising to repay the loan after agreed term. In the most typical private money transaction, where an investor rehabs and flips a house, the lender funds either all or most of the purchase and renovation. The idea is you do the deal so cheap in relation to the after repair value that the lender is protected. And I'll demonstrate that for you in a bit, and I'll show you how to show that to your lender. But oftentimes the lender may not be comfortable with that much risk with funding the entire purchase price and renovation, or a large chunk of it, and require you to put what's called skin into the game, right? Or your own money into the deal, a little or a lot. Typically this is true for risk-averse lenders or individuals. Or they may not be happy with the interest rate you're offering and want a higher return, which means they have a higher risk appetite. So the return your private lender gets typically should be commensurate with the risk that he takes on. And this is a really sophisticated graph that I came up with, right? So where's my mouse? Okay, so you start over here, and hopefully you can see my mouse, which, and I'm going to go through these scenarios shortly, and these numbers are purely for illustration point purposes. But you start over here in a low risk, low return scenario, low loan to value debt that your lender gives you. And as you go up the risk spectrum, your lender lends you a higher loan to value amount. Potential return goes up. Then you get into the debt and equity scenario. And don't worry about what this means. I'll explain all this in a second. But basically, the more risk that your lender takes on, meaning usually the more money they're lending you versus the value of the property, their potential return should go up as well. So these are the scenarios I'm going to show you. First one is what's called low loan to value debt. A lender funds 50% of both acquisition and rehab. Or a lender funds acquisition, no rehab. Higher loan to value debt. Lender funds everything with just a straight interest rate. Or lender funds everything with also rolling in closing and holding costs. Then I'm going to show you a scenario called debt and equity, which is where lender funds everything. You give them an interest payment and a profit split. And this is what's called debt and equity, with there being a smaller profit split. And then I'm going to show you a scenario that's called 100% equity, where lender funds everything with only profit split. And this is really called equity only. And again, don't worry about what this means. I'm going to go through each one of these in detail. So again, if anything doesn't make sense, pause the video, rewind it, and take notes. So this is the example deal that we're going to look at. Purchase price $100,000. Your required repairs are $37,000. Closing and holding costs are about $3,000. So your total cost basis, not including your financing, cost of financing, is $140,000. And your after repair value, or your projected resale value, is $200,000. So before all you California people get up in arms because you can't find deals at 70 cents on the dollar, um, you know, I'm sorry, you guys are in a really competitive market, so this is just for illustration purposes. I'm buying deals like this still on a regular basis. Thank God. So, but this is how the numbers look. You're buying the property at 50% of the after repair value, right? The after repair value is what the property will appraise at and what it will be marketed and sold at once the renovations are complete. Once you're done with your renovations and once you count for all of your soft costs, your total cost basis is 70% of that after repair value. And so that leaves you 30% for a profit margin. So let's start with the lowest risk scenario, low loan to value debt. And this is the version 1 of that scenario. Lender funds 50% of the cost of the project. That means they fund 50% of the acquisition and 50% of the renovation. And just because I'm showing you this scenario doesn't mean that this is the scenario you should go for, right? Obviously, for you as an investor, this is not optimal. You don't want to put your own skin in the game. You want to use somebody else's money. But I'm going to show you how to structure this in case you ever encounter a lender that requires this type of scenario, right? If you've got no other choice, if the only money you can find is from somebody that says, well, let's go, I'll fund 50% of this project. Another reason why I'm going to show you how to structure this is if you ever go to get a construction loan from a local bank, they typically use this scenario, only the number is 80% instead of 50%. So most of my construction loans are where the lender funds 80% of acquisition and 80% of renovation, and I've got to come up with the rest. So again, lender funds 50% of the cost of the project. Investor you is responsible for funding 50% of acquisition, 50% of rehab, and then you cover all the closing, holding costs, and you make interest payments during the rehab. And note that this is what's called a debt structure. I'll show you another version of this later on. So let me show you how to structure this in Rehab Valuator. Okay, so this is the welcome screen of Rehab Valuator. If you go here to Rehab and Flip or Hold Analysis, I've already got the purchase price, closing, holding costs entered, as well as the cost of rehab. And so you simply click inside this blue box and you switch from all cash for your short-term financing, and you select financing. And you're given two options here for how your lender finances your project, based either on cost as a percentage of cost or a percentage of after repair value. So in this case, we're going to say your lender will fund a certain percentage of cost. And again, if it's a bank and you're getting a construction loan, this would be 80%, but let's say you're dealing with an ultra conservative private lender. You punch in 50% here, and let's say you're paying him an 8% interest rate, and under the option interest payments during rehab, you select yes, and there is no profit split. So you can immediately see that if you sell this property for $200,000 with a 7% cost of sale, this will be your return. And here you're able to see, well, this is what your lender actually lends you, and this is how much cash you will have to come up with for the deal. So you have to come up with $68,500, which is, the 50% of the acquisition and renovation, and then you also have to come up with $3,000 in closing holding costs, and then you've got to make interest payments, and in this case for 6 months. We're saying it's going to take you 3 months to rehab and 3 months to sell. The project will take a total of 6 months, and so you will end up coming out $74,000 $240 out of pocket. And if you go to view reports, you can click on private lender funding request, and this is what you would show to your private lender. You're basically showing, okay, after repair value is $200,000. This is the cost of the project, $100,000 to acquire it, $37,000 to renovate, and I need you to fund half of that, which is $68,500, and it's only 34% of the after repair value. So this is why we call this scenario a low loan to value debt scenario, because this is only, your lender is only giving you 34% of the value of the property when the renovations are complete. And here we've got the timeline, and you can enter some notes here under project description. You can type in the description of the property and notes about your exit strategy and the loan terms. And then here you're showing your lender you will earn a total of $2,700 in interest, and you will make an 8% cash on cash return. So if we click print reports, this is what it would look like, right? Just a one pager. When you're sitting down with a prospective lender, you can just bring this to the meeting, or you can email this to him as a PDF report, and it just very quickly summarizes the deal, right? This is the cost base of the project, this is how much money I need, and this is how much money you'll earn. So let's recap. If we go back here, right, back to my slides. Purchase price is $100,000. Cash required or repairs required is $37,000, right? So this is the total cost basis is going to be $140,000. Projected resale price is $200,000. Lender puts up $68,500. You as the investor put up $74,240. Your lender makes a 8% annualized cash on cash return. And because you're making a pretty healthy profit on this deal, this is your annualized return on your cash. So even though you're putting up a lot of cash for this deal, you're making a pretty damn good return on it. So now let's look at another alternative of this, right? This is called low LTV debt version 2. This is where your lender funds the total acquisition but does not fund the cost of your rehab. So you as the investor are responsible for funding rehab, closing costs, holding costs, and interest payments during rehab. So this is going to be a slightly higher loan to value, but still it's considered a low loan to value debt, right? So let's go back to Rehab Valuator. If we go back here, and here it gets a little bit tricky because you kind of have to backdoor your way into the calculations. So you're still saying that your lender will finance a certain percentage of your cost, but to determine what percentage, we're actually just going to create a formula here. So your lender is basically financing $100,000 out of $137,000, right? So we're going to say equals 100 divided by 137. So your lender is financing 73% of the cost of your project. And if you're not with me on this, let me go back through it, right? Your lender will finance your purchase price, which is $100,000, and the total cost of the project is 100 plus 37,000, right, in renovations. So here you just create a formula. What percentage of the cost will my lender fund? Well, 100,000 out of 137. And immediately you can see here, boom, total loan amount, $100,000. Everything else stays the same. You're paying them 8% interest rate. This is how much cash you now have to come up with out of pocket, $44,000. Your profit on this deal, if everything goes according to plan, will be $42,000. And if we look at your private lender request, it looks a little bit different, right? You're requesting $100,000 in funds. So here, let's look at this thing in the print format. You're requesting $100,000 in funds, which is only 50% of your after repair value. Again, a low loan to value scenario, right? So how do the numbers stack up here? Well, here your lender puts up $100,000. You only have to come up with $44,000 in cash. Your lender still makes an 8% annualized return on their money. And because you have to put up less cash, your cash on cash return on an annualized basis goes up. So if I were you, I would have the software open and just follow me along while we're doing this. So let's move on to, and again, so low risk equals low return, right? In my book, an 8% return is kind of low. And by the way, I'm not telling you to specifically offer your lenders 8% return, right? This is just an illustration. It's completely up to you, whatever you negotiate. I'm just using an 8% number as an example, right? But a low risk, because your investor is only lending you 50% less of the after repair value, only warrants a relatively low return, right? So here a lender still gets first lien on the property, right? Optional, you can give them a promissory note. It's relatively low risk because if the deal doesn't go your way, if you stop making payments, they can foreclose on you, right? And they'll actually end up making more money on this property if they're smart by foreclosing and selling the property to somebody else. And so this is purely a debt investment. So now let's look at two more structuring scenarios where the loan to value percentage goes up. This is called higher loan to value debt version 1. Lender funds 100% of the cost of the project. You as the investor are simply responsible for funding all closing costs, holding costs, and making your interest payments during the renovations on a monthly basis. And again, do I recommend that you structure your deal where you have to make monthly interest payments? No. And I'm going to show you another scenario where you don't. But again, I'm showing you how to structure these deals in the most flexible manner to accommodate your lenders. So let me show you what that looks like. So we go back to our financing scenario and we simply say my lender will now finance 100% of the cost of the project. And there's no points to pay. You know, if this was a portfolio lender, you would probably have 1 point origination discount point to pay, and you'd have some closing costs associated with the loan, which would be, let's call it 3%, right? So you would plug those in. But because this is private money, you typically will not be paying points, except for a scenario which I'll show you towards the end of this video. And you're still making payments during the rehab. So this is how the numbers change. You can see the total loan amount now goes to 137. Your lender financing your acquisition and your rehab. And your cash required over the life of the project is simply your closing, your holding costs, and interest payments to the lender over the 6 months that you're doing this project. Your projected profit is $40,520, assuming you can sell it at $200, and your annualized return on investment is huge, right? Because you're only putting $8,000 into the deal, and this is how it looks from your lender's perspective. Now your lender is putting up $137,000, which is 69% of your after repair value. Still a very reasonable risk to your lender. It still has plenty of cushion. If you can renovate properly, the property will be worth $200, and your lender is only putting $137 on the line. Here you're showing your private lender that you're still offering, well, you know what, let's go back because let's bump up the interest rate to 10%, right? Because this is a higher loan to value, it's slightly more risk to your lender, and so you should be compensating them and paying them a higher interest rate, 10 or 12%. Again, I'm just using these numbers for illustration. It's whatever you negotiate, right? But basically, in this one pager, you're showing your private lender, okay, you're going to put up $137,000. I'm offering you 10% interest rate. you're going to make $6,800 over the course of the next 6 months, and your cash on cash return is 10%. And by the way, you can click on print reports and full presentation for private lender, and then you can just create a 5-page presentation, right? It's going to have your cover page, your one-pager here, cash flows. You're showing your private lender exactly when they will have to disperse money, right? $100,000 at acquisition, and they're also going to disperse $37,000 to you at closing for repairs. Or there's an option in the software that you can actually do this $37,000 in draws, which is what any normal bank requires you to do. And this is how much interest you're paying them. And this is what happens when you sell the deal, right? So this is all about building your credibility. Comparable sales report that you can put together to show your lender that, look, similar properties are selling for around $200,000. And of course, additional pictures. All right, so this is how the numbers stack up on structuring method number 3, right? Same numbers up here. Now your lender puts up 137. You put up slightly under $10,000 in cash to cover your closing, holding costs, and interest payments. Your lender makes a 10% annualized cash on cash return, and you make close to 800% on your money on an annualized basis if you sell a deal at $200,000 because you're putting up so little cash. Right? So you see the pattern here. We're going from you putting up a lot of cash to putting up little cash, and now I'm going to show you a scenario where you put up no cash. This is called higher LTV debt version 2. Lender funds 100% of the cost of the project along with paying for your closing and holding costs. And this is key, your interest payments are deferred until the property is sold and loan is paid off. So this way, you as the investor are responsible for putting up zero cash into the deal. Let me show you how to structure that. Go back to this, and you've got an option here that says include closing and holding costs in the loan. So notice, right now this says you need to put up $9,800 in cash. Now let's roll the closing and holding costs into the loan, and you can see that decreased by $3,000. And here you've got an option that says interest payments during rehab. Say no, I will not be making payments during the project. And all of a sudden those interest payments got rolled into your loan, and your cash required over the life of the project just went to zero. And this is how that looks. All right, let's take a look at this. Total funds needed from the lender is now $140,000, which is your purchase price plus rehab plus closing and holding costs. But look, it's still only 70% of your after repair value. So when you're using this to meet with your private lender, this is what you want to show them. Look, I've got comps to prove that the after repair value is $200,000. So you're only risking $70,000 on this deal. Or, I'm sorry, 70% of the after repair value on this deal. And then you're deferring close to $7,000 in interest, and so the total loan amount at the end of this deal that you'll be responsible for paying off will be $146,000, which is 73% of your after repair value, and you're offering 10% interest rate, and boom, there is a total interest income to your lender, and they're making a 10% cash on cash return, right? So if we go back here in my fancy slide presentation, this is how those numbers look. Lender puts up $140,000, you put up zero, right? So ideally, this is how you want to structure it. If you can get money at 10 or 12% interest and you find good deals, you want your lender to put up all of the money, and you're doing all of the work, right? So you put up zero cash, your lender makes a 10 or 12, whatever, 14% return on their money. The lower the better for you. And you're making an infinite cash on cash return because you didn't have to come up with any cash. Pretty good, right? So now here's where things get a bit more interesting. Let's say a potential lender is not happy getting an 8 or a 10 or 12% return. Let's say he wants something north of 12%. Most investors would just give in and say, no problem, I really want this deal, so I'll pay you 14% or I'll pay you 16%. I really want to do this deal. But from where I stand, for my lender to get a 14% or higher return, they need to take some risk beyond just lending at 70% loan to value with the first lien. So here's what I would do. I would actually decrease their interest rate, but increase their potential return. How would they do that? Well, here's a hybrid debt and equity structuring method where a lender funds 100% of the cost of the project along with closing costs and holding costs. Interest payments are deferred till the property is sold and loan is paid off, just like the previous scenario. Investor is responsible for zero cash into the deal. And let's say you only pay your lender a 4% interest rate, but you also put in a 25% profit split, right? 25% of the profits when you sell. So lender still gets a first lien on the property, but gets upside if the deal is successful, right? So the lien on the property and the 4% interest rate, that's debt. That's what's called debt. But upside, now they have equity in the deal because they have upside and they will make more money if the deal is successful. So this way, if the deal is not successful, you don't owe your private lender as much money, right? This way, your private lender is sharing the risk and the upside with you. He's only getting a 4% guaranteed return, but if the deal is successful, let me show you how those numbers will look. Let's go back to the software. And now let's go here and let's say we're going to drop the interest rate to 4%. But here you've got a switch that says split back-end profits with your lender. Yes. And we're going to give them 25% of the profits. So am I advocating that you split your profits with your lender? No. But if your lender demands a higher return than an interest rate you're willing to pay, this is a way for you to get funded, make your private lender very happy, right? And be able to do the project. Check this out. If you split your profits with your private lender and you give them 25% and you sell the deal at $200,000, you're still making 32 grand without having to put up a penny into the deal. Your lender, this is how your one-page presentation would look. Your lender puts up $140,000 in cash, and you're also deferring $2,700 in interest. Remember, you're only paying 4%. But look, now you've got this that appeared out of nowhere, which is profit split to lender 25%. And this is where it gets powerful. This box here shows your projected financial results for your lender. He's going to make only $2,700 in interest, not much. But your profit split will be almost $11,000. So the total income is going to be equivalent to almost a 20% cash-on-cash return to your lender if the deal goes the way you say it will go. That's pretty powerful, right? Your lender is happy. Now your lender is effectively your joint venture partner, right? They're happy. You're happy because you got the deal funded. You didn't have to put up any money, and you've made a nice big profit. Everybody wins. All right, let's go here. Boom. Again, lender puts up $140,000. You put up zero. Lender makes almost a 20% cash-on-cash return. And your cash-on-cash return is infinite. Right? Everybody wins. Your lender is happy, or let's call him your partner now, is happy. You're happy. Boom. Let's do the next deal. Are you better off only paying 8, 9, 10% interest rate flat without profit splits? Absolutely. But this is the way you would structure a deal is if you encounter somebody that requires a higher rate of return. Don't just pay them an obnoxiously high interest rate, right? Tie their success to the success of your deal. So this will be structuring method number 6. And we're going to call it pure equity. Again, lender funds, or he's now basically your JV partner, funds 100% of the cost of the project along with closing costs, holding costs. Interest payments are deferred till the property is sold. You are responsible for zero cash into the deal. This should just say pure equity. Here, let's just edit it on the spot. How about that? In real time. Pure equity. Good. All right. Lender effectively becomes your JV partner. They put up the money, you run the deal, and you split the profits 50-50. There are no interest payments to make. You simply pay your partner if your deal makes money. You can choose to give them a first lien in the property or not. Again, it's really up to you and what you're able to negotiate. So if we go back to the software, this is what it would look like now. We zero out your interest rate and we bump up your profit split to 50%. So now you're simply 50-50 partners. They put up the money, you do the work, split the profits down the middle. If the deal is not successful, you don't owe them interest. You're both sharing the risk in the deal. You make $23,000 on the deal, and if we look at your private lender, right? So if you go here, same thing. They're responsible for funding $140,000, which is 70% of after repair value. Interest rate offered to lender is 0, but you're splitting profits 50-50. And this is your projected financial results. Their entire profit is going to come from this profit split when you sell a deal. 23 grand, which is equivalent to almost a 33% cash on cash return on an annualized basis for them. That's pretty damn strong, right? But the reason why the deal warrants that's this kind of return for them is because they're taking on additional risk, right? There may not be a first lien on the property for them, right? They may not have the ability to foreclose on you. They're just 50-50 partners with you. And they're not getting a guaranteed interest rate or any kind of payments from you. So where's my super snazzy chart here? Here we go. As their potential risk to the lender goes up, so does their potential return, right? So, sorry if you're getting dizzy watching this. I'm almost there. So look, structuring method number 6. Same as before. They put up 140 grand, you put up 0, but their cash on cash return is now almost 33% because they're your 50-50 joint venture partner. So, and here's the thing, right? If you're talking to somebody and they tell you that, for them to fund your deal based on the numbers that you gave them, they need to get at least a 20% return. Well, use the software to play around with different profit splits. You can see, right? Given our scenario, 50% profit split is 33% return to the lender, right? And as you go down in profit splits, boom. Play around with the software. You can see what it takes to get them to a 20% return. Don't give your money away if you don't have to, right? If your JV partner wants 20% return, offer them a 30% profit split and then show them the presentation. This is how you get to a 20% return. And look, if at the end of the day you end up selling the deal for 190 instead of 200, use the software to run the numbers again, right? So if we go back here, let's close this out. Let's say you only sell it for 185, right? Well, before, a 30% profit split got you to a 20% return to your lender. but now they're only at 14%. So bump this up to 40, right? Bump this up to 43%. When you sell the deal, look, you can still make it right by your JV partner if you want and give them a bigger profit split when the deal is sold and you know what your sales price is, right? So you can use the software before the deal and after the deal. Hopefully this makes sense. If not, watch what I just showed you again. So let's review the 6 different structuring methods and the results that we just went through before I show you a bonus strategy. So the first one was called low loan-to-value debt, where lender funds 50% of both acquisition and rehab. And in our example, the lender got an 8% return. An alternative of this strategy was a slightly higher loan-to-value, where lender funds acquisition but no rehab, and we also pay them a similar return of 8%. Higher loan-to-value debt, where a lender funds everything with a straight interest rate, and we pay them a higher interest rate because the lender was funding us more money and a bigger percentage of the deal. We went a little bit higher in loan to value, where a lender literally funds the entire cost of the project, including closing and holding costs. And this is really, I call it the highest loan to value debt, because the lender couldn't really give us any more money because they already funded 100% of the project. And then we got into a hybrid of debt and equity, where we pay a lender a smaller interest rate but give them a profit split and give them upside in the deal. And so lender ended up earning close to 20% profit, 20% return actually. And then finally we went to basically a JV partnership, where a lender is just a 50-50 partner with you. They put up the money, you do the deal, and they get a bigger profit split, where the lender ended up earning, or your partner really ended up earning 32.8% return on their money. So just a quick recap for you. So I want to show you this bonus strategy, and if you saw the first video that I recorded, then I talked about this, but I like this strategy so much, and it's so obvious yet so few people utilize it, that I wanted to go over it again because it's really strong. So here's what it boils down to. This is a way for you to borrow money from people that don't have any money to lend. Right? Think about that for a second. Let it sink in. You're going to borrow money from people that don't have any cash, that don't have any self-directed IRAs, don't have any savings. How can you do this? I've personally borrowed well over $100,000 just using this method in the last few years. So you find someone who has an untapped home equity line of credit. Usually it'll be against, and excuse my typo, a primary residence. This is untapped borrowing power that this person has. So again, think about it for a second. Somebody may not have much savings, may not have a self-directed IRA. They don't fit the profile of your typical lender, but they have an untapped home equity line of credit, and usually these home equity lines of credit against the personal residence are at very low interest rates. Right now, as I'm recording this, interest rates are basically at an all-time low. So people have home equity lines of credit at 3-4% interest. This is cheap money. So what I typically do, and I've traditionally done this, utilized this strategy with people that are close to me, friends, family, people that already know me. And typically these have been smaller amounts, $30,000, $40,000, $50,000 a piece. Here's what happens. They write a check to you out of their credit line, because that's how these credit lines work. You basically can just write a check and tap that credit line. This is key. And this is how you sell it to them. You pay them 4 to 6 points upfront. Points are simply percent of the amount that they're lending you. So if somebody lends you, well, let's start at the beginning. You pay them 4 to 6 points upfront, and then you make their monthly interest payments every month until you repay the loan. Your lender is happy because they got to lend somebody else's money. So again, think about it. They're lending not their own money and putting their own money at risk. They're lending their bank's money, right? And they make a nice chunk of cash up front. So for example, if they lend $50,000 to you out of their home equity line of credit, and you pay them 6 points, you're writing them a check for $3,000. So what if you don't have this $3,000 sitting around? Well, they write you a check for 50, you deposit it, and simply write them a check for $3,000 back. Think about that again. You just created a lender from a pretty unlikely source, and your cost of money on an annualized basis is only around 10% using this example. This is pretty powerful stuff. It really works well, and typically when I've done this, because it's been with people that know me and trust me and know that I'm good for this money, I've done this without giving them first liens on a particular deal. I've done this without promissory notes. I've done this with friends and family where they just write me a check and we have a verbal agreement. And so I've taken this $50,000 or $60,000 and used it for multiple deals. Right? So this strategy has been very easy money for me. And these people know that I would bend over backwards and pay them back even if the deal failed. You know, I so But you can structure it just like any other private lending transaction with your lender, where you give them a first lien on the property. So if you were to use the software to do this, then this is what it would look like. Let's see. You would say, if they were financing a particular deal for you, and let's say it's still at 100%, well, you would simply put points here, right? Origination discount points, 6 points, paid up front, no profit split. And then if you're presenting it to them, you want to leave this interest rate blank because you want to show your lender what they're going to make. So it would look like this. You would show your lender, look, you're going to write me a check for $140,000. I'm offering you 6 points up front, so you're going to earn $82,000. And for the strategy that I'm showing you now, you don't even need to use the software. It's pretty simple math, right? Because this cash on cash return is not even relevant to your lender because this is not their cash that they're lending. But if you're analyzing this deal for yourself and you want to see what your cost of money is, then you would put 6 points here, and you would put let's say a 4% interest rate here. And so now you can run the numbers on the deal knowing exactly what your cost of money is and figure out what your projected profit will be. So it's pretty easy. Couple of other things I want to show you before I let you go, and these are pretty important, right? So again, with the software, you've got the ability here to put together a full presentation for your lenders. I mean, again, if you want to talk about building credibility and making it much easier for people to trust you and to get your deals funded, you use this. Cover page, the one pager that we talked about. You got the cash flow report that shows to your lender exactly how cash flows will be distributed. Comparable sales, which prove to your potential lender that yes, you can sell the deal at the price that you say you will because similar homes are selling at similar prices right now. And then you've got additional pictures page. In addition to this, you can put together a detailed rehab budget, right? You can either do a quick lump sum here, or you can put together a very detailed budget and scope of work, and you can show to your private lender, look, this is exactly where the rehab money is going to go. And we've also recently added an option here where you can either get your entire rehab budget funded at closing, or you can do it in draws. So you get maximum deal structuring flexibility. And lastly, you can apply the same strategy if you're buying, rehabbing, and holding deals with the second exit strategy. So a couple of things I'd like you to do after watching this video. Number one is, if you liked it, there's a button below this video that will allow you to share it on Facebook as well as Twitter, and I would really appreciate you sharing this with your friends and contacts on both of those social media networks, and just sharing this content with as many people as possible. Number two is, leave me a comment below. Let me know what you thought. Let me know if you found this helpful. Let me know what questions you have. And also, if you'd like to see more tutorials and case studies about other subjects, leave me some suggestions below as well. If you don't have Rehab Valuator premium software yet, then unfortunately you don't have the ability to create marketing reports and presentations like the ones I just showed you, among some other things such as marketing your wholesale deals, creating detailed rehab budgets, and more. And right now, you can click on the link below and get a permanent license to the software for just $97. It's a one-time payment. And I wanted to read you a couple of quick testimonials from our current clients that are using this software to achieve awesome results. Evan said, since you came out with the private lender marketing capabilities earlier this year, I've been using your program to pitch deals to a few lenders I lined up through my church. I've secured funding for 5 deals so far using your software to structure the deal and present it with approximately $270,000 in funding. Keep up the good work, and I look forward to the improvements this summer. This was right before we came out with the new release, the latest release. Bart Corey, who's a good client of ours from Nevada, said, I've been using Rehab Valuator Premium for over 6 months now, and it is the best. Talk about building instant credibility. I presented 2 deals to new private lenders that I had never done business with before and gained $600,000 of funding for my deals. These 2 new deals netted me over $200,000 in profits, wow, in just 3 months. Your support is not like any other I have ever experienced. Daniel, you and your staff are quick to respond to my support requests and resolve any question I may have, and I'm back to work. For all the investors out there, I highly recommend this product. Grab it now before the price goes up. It's worth a lot more than what Daniel is charging. And just as a disclaimer that I'm required to give you, we're not guaranteeing you're going to achieve similar results to Bart or Evan or anybody else. These guys are, they hustle, they network, they are out there all day long looking for money, networking, doing all the right things. Our software alone will not get you funding for your deals, but it will help you tremendously look credible and professional when you're dealing with your potential lenders. Jim Stallings said, I've got your premium rehab Valuator software and I love it. It is awesome. I've been real estate investing for 13 years and have spent several $1,000 in training, seminars, courses, coaching, and I've never seen anything close to what you offer, especially for such a great price. And Margaret said, I think this is the last testimonial I'm going to read you guys. I just used your rehab valuator for the first time and I wholesaled the house in 2 days. I picked up $5,000. I only have about 8 hours in on this first deal and could not be happier. Rehab Valuator allowed me to appear professional to my list of buyers and actually had 3 more people express interest in the house because of it. It really takes the guesswork out of the equation and allows you to present your project in a clear and concise way. I will now use it on every opportunity. Thanks again, Daniel. And just to be clear, Margaret was using a different sector of our reports that are specifically geared to creating marketing materials targeted to your wholesale buyers as opposed to lenders. And I literally have by now a couple of hundred more testimonials like these from our clients all over the country that are using the software to close deals, whether it's selling their deals or getting their deals funded. So here's what you get if you upgrade today. You get a permanent license to the premium software, and permanent means you have a license forever. There is nothing more to pay over. No monthly charges, nothing. You get a 30-day, 100% money-back guarantee, no questions asked. You get immediate access to the software. We're going to send you, as soon as you fill out the order form, a download link for the software. There's no waiting for it in the mail. And that's actually also good because if you ever lose your computer or erase your hard drive, you can go right back to our website and download the software again. You get unlimited customer support, and if you've dealt with us in the past, or if you just listen to some of the testimonials, we take very good care of our clients. I am absolutely religious about customer service. And finally, you get extremely detailed video tutorials that walk you through every step of using the software, and it's pretty easy. And obviously you get online case studies like the one I just recorded as well. And if you order today, I'm going to throw in a couple of bonuses that I think are very relevant to the software. Number one being this video has been very popular with our clients. It's a 45-minute video on properly estimating rehab costs. It was recorded by Jerry Norton, who's rehabbed and flipped hundreds of properties just in the last few years. This video basically shows you how to walk into any property and create a rehab budget for it in under 15 minutes and know what your repairs will cost you. It's an awesome video. I've been rehabbing for 5 years now, and I still learned a lot by watching it. And I've put together a library of ebooks that specifically deal with sourcing the best, cheapest deals in today's market, right? Whether you're wholesaling or buying deals for yourself, you need to be on top of the latest strategies that work on how to find the best deals. Otherwise, you have no business. You've got nothing to wholesale, you've got nothing to rehab unless you're finding the best, cheapest deals out there. And these ebooks deal with just that subject. And each one typically sells between 100 or between $50 and $100 each. I'm giving them to you for free. And then finally, you get a special report called How to Hire Contractors Without Getting Ripped Off. And it's a great report, and it's a $50 value. So all in all, similar programs to Rehab Validator are selling for at least $200 out there, and most of them carry pretty hefty monthly charges with them. So that's a $197 value, and along with all the bonuses, you're getting a value of over $500 easily, and you're paying $97 one time today. And I've been threatening to raise the price for a while now. What's going to happen is by the beginning of next year, I'm probably going to transfer to a online version that's going to have a monthly fee with it, and I'm going to get away from the $97 one-time payment. So take advantage of this now. That's really my suggestion. All right, and that's the end of my presentation. I hope you've gotten some really good value out of it. I hope you've learned it. I've learned a good amount of information. Take that information and put it to use. That's the only way it's going to benefit you, is go out, find some potential lenders, use the software to structure your deals, to create presentations for when you negotiate with them. And again, if you don't have the software yet, it's a freaking no-brainer. $97, you'll make that back 20 times on the first deal you do. And that's it. Thank you very much for watching, and leave me a comment at the bottom. Click the Facebook like button and share this with your friends.